Welcome back. Let's check in on business news now. China's economic growth has slowed to 6.2% in the second quarter, its worst performance in almost 3 decades. And demand has faltered in line with analyst expectations as the US-China trade war and weakening global demand took a toll on the world's #2 economy. Along with quarterly GDP growth figures today, we also have some clues as to how China's economy did in June. Growth in infrastructure investment has retreated from years of near 20% expansion, coming in at 4.1% growth in the first half of the year. Imports and exports both shrank in June from a year earlier. China's exports to the world rose only 0.1% on year during the first 6 months, while exports to the US dropped more than 8%. Urban unemployment ticked up to 5.1% for the month from 5% in May. But there were some bright spots for China's economy. Stronger than expected gains in June factory output and retail sales offered some signs of stabilization. However, industrial output climbed 6.3% from last year, picking up from May's 17-year low and surpassing a forecast for 5.2% growth. Fixed asset investment for the first half of the year rose 5.8% from a year earlier. And China's 1.3 billion consumers, they've also continued to open their wallets, buoying the economy. Retail sales for June grew 9.8%, eclipsing expectations. However, sales of big-ticket items like cars didn't hold up. Its sales down 12.4% in the first half of the year. Its debt-to-GDP ratio, excluding the financial industry, totaled close to 250% at the end of March, and this was according to government think tanks. So that raises fears that any stimulus push will expand Beijing's debt even further. Now, for more insights, we're joined by Zhuang, and he's TS Lombard's chief China economist. Zhuang, thanks for coming in and speaking to us. All right, so China's slowest economic growth in nearly almost 30 years. Many have attributed this to the ongoing trade spat with the US. What is your take? Is that to blame or domestic factors the main culprit here?
So far, based on the data, first half of the year, the key factors are the domestic factors, and especially consumption slowdown was one of the key drivers behind the slowdown. On the other hand, the investment in China have actually recovered, and at the same time that given all these trade uncertainties, net contribution from the export in China was still positive in the first half of the year.
Okay, so growth slowed, still in line with what our market are expecting, but should we be worried with this though?
We have been actually expecting China's growth to slow down for some considerable time. After 3 decades of the high growth rate, now China is moving towards a mid-range growth rate, for example, 5 to 6% range, and then this is highly expected, and then I don't see any surprise factor over there, and then that's the medium-term trend. But we do see some uncertainty of the trade war, tariff uncertainty, growth uncertainty in terms of medium run, i.e. the next 4 to 6 quarters.
All right, so what can Beijing do to boost things then?
There are a couple of policies. For example, so far in the last 12 months, Beijing have been mostly using the fiscal policy, i.e. the pumping up the fiscal expenditure, using more infrastructure project investment. Beijing can still continue to pump more money to do fiscal spending. On the other hand, there will be some further monetary credit easing as well. Although people are still more worried about the Chinese debt level, but I do not think that 250% is the cap that Chinese debt should stop at. So there are still some room for a moderate credit easing in China to boost growth.
Okay, so what is the cap then? If 250 is not the number, what is the number that you're actually looking at then?
For example, I do see a very similar between China and Japan. But Japan at the moment, debt is at 350%. And China and Japan, the similarity between these two countries, they are mostly domestic saver denominated debt, i.e. this local currency held by domestic savers, and which is different from other smaller emerging markets, and which are typically exposed to 2 risks. One actually is the foreign denominated debt, and the other one is duration mismatch. But this does not exist in China or Japan.
Okay, so saying all that, how does that then affect the rest of Asia, especially us here in Southeast Asia?
We have seen the China slowdown. For example, as you mentioned earlier, Chinese import growth actually have plunged 7-8% year on year, which means that Chinese demand from those Southeast Asia countries have actually declined, so which is negative for Southeast Asia. On the other hand, countries like Vietnam, Cambodia, Indonesia are receiving huge amount of the Chinese investment because of this trade uncertainty. For example, that Chinese companies are relocating their productions to Vietnam in order to escape those trade tariffs which impose on Chinese goods, which this second point being a very positive factor for some countries.
Okay, so let's go back to China. It's not all doom and gloom for China. Some industrial output and retail sales easily topping forecasts. Is that safe to say that there's still some bright spots for Beijing then, correct?
Yes, there are some bright spots for Beijing. So far, I think consumption is doing reasonably well. It's not collapsing. I think that one of the brightest spots, I would say that so far, housing investment in China has stayed up. And that's to surprise of many of us. I think that will be the one of the comfort point we should take.
All right. Thank you so much, Zhuang, for speaking to us. Zhuang, the Chief China Economist at TS Lombard.
Thank you.